Hello everyone, Michael Eastham here, and a warm February welcome to our Fellowship Financial Group friends and family. It is time for another market update. Well, the first month of the new year was actually a good one for financial markets, thanks largely to the Federal Reserve. In December, the Fed slowed down its schedule for raising short-term interest rates and said that they'd likely slow down even more at their next meeting in February. Some positive economic news made investors more optimistic that the Fed would actually keep its word, and it all resulted in a positive month in the markets. But will that positivity continue? And if it does, for how long? Well, as you know, the Fed began raising short-term interest rates at a pace in early 2022 to try to rein in the rising inflation. And that rapid pace kept downward pressure on the stock market all year and pushed long-term interest rates up to the highest level in 13 years. That was a big deal. The Fed only began slowing down after inflation had shown signs of slowing for 5 straight months. Starting in July of last year is when things really started to slow down. Well, in addition to raising short-term rates by only 0.5% in December, after they had raised them by 0.75% 4 times in a row, the Fed also strongly indicated that they'd probably enact an even smaller 0.25% of an increase in their next meeting in February. The Fed's words were actually bolstered by some positive economic data that was released in January. Inflation, as measured by the CPI, or the Consumer Price Index, slowed yet again in December, falling by 0.1% for the month. And economic growth measured a healthy 2.9% for the fourth quarter. And with all that, investors priced in a 100% chance that the Fed would stick to its plan for only a 0.25% rate hike in February, and they were right. So as a result, the S&P 500 finished January up by 6.2% for the month. At the same time, long-term interest rates ticked downward, with the rate on the 10-year government bond dropping from about 3.8% at the start of January to 3.5% by the end. Now, that's down from its November 2022 peak of 4.25% just a few short months ago. But recession is still a concern, right? Well, the Fed's more dovish tone and the actions made investors happy for a couple of reasons. The first is that falling interest rates have a positive effect on the value of all financial assets, just like rising rates has a negative effect. And remember, the market doesn't value stocks and bonds based on where rates are now, but where it believes that rates are headed in the future. So if investors think that rates are going to rise, then the market typically sinks. And if they think rates are going to stabilize or fall, then the market rises. Well, the second reason investors were so optimistic in January is that with the Fed slowing and nearing their target level for short-term rates, which is right around 5%, the chances are diminished that we'll see a recession in 2023. Now, that doesn't mean it won't happen, but many economists are still forecasting a recession this year, and I agree that there's probably at least a 50-50 chance that it could happen. But those odds would increase greatly if the Fed were still committed to raising rates at an aggressive pace rather than slowing down and nearing the finish line for interest rates. What's more, if a recession does occur, they now have plenty of ammunition to combat the recession by lowering short-term rates again. And they didn't have that flexibility a year ago when short-term rates were still near zero. That means that even if we do get a recession, it isn't likely to be very long or very painful. So what's the impact on your portfolio? Well, as I noted, the S&P 500 finished January up by 6.2% for the month, and long-term interest rates notched downward a bit. As a result, both our Sound Income Strategies stock and bond portfolios finished the month up by a level commensurate with the stock market, just over 6% on average. So depending on your individual holdings, you may have seen all or some portion of that. And that means that if you saw your values down on paper around 12 to 13% for 2022, you regained about half of those losses back in January. Remember, those are just on paper. Now, could we give some of those gains back in the coming months? Well, of course we can, because although January was a good month and the markets are optimistic for now, the fact is that the Fed hasn't reached the finish line quite yet. And until they do, the markets are likely to remain in a pattern similar to what we saw throughout 2022. Up one month, maybe down the next. That's just typical whenever the Fed is raising interest rates because of all of that uncertainty that exists. And even after they're finished, the recession question could keep investors on edge for quite a while longer. In addition to other potential concerns like looming the showdown that's taking place in Washington over the debt ceiling. But with all that said, I'm still optimistic, just like I said last month, that calmer seas are on the horizon at least, and we'll return to a more normal market cycle by the end of 2023. In the meantime, you can take comfort in knowing that you remain well equipped to ride out the rough seas because you decided to shift your financial focus from total return to income. In other words, whether your statements are up or down from one month to the next doesn't really matter because you know your income return is unaffected and the face value of your investment is less impacted regardless of any fluctuations in the values on paper. Well, that's it for this market update. Thanks once again for the privilege of serving each and every one of you. It truly is our passion. The entire team at Fellowship Financial Group is grateful for the confidence and the trust that you've placed in us. We don't take that lightly. But as always, call our office anytime if you have any questions or any concerns, especially if your goals or your needs change, as they do from time to time. And if that's the case, we should definitely talk about it to help determine if your current investment strategy needs to be adjusted in any way to keep your strategy aligned with your goals. Well, have an amazing month, and we'll be back soon with another market update.